Good morning, ladies and gentlemen, and welcome to Equity Trustees Holdings Limited half-year results presentation. This is Mick O'Brien speaking. I'm the Managing Director of the company, and I also have with me Philip Gentry, who is our Chief Financial Officer and Chief Operating Officer. So this morning I'm going to give an overview of how the business is travelling. Philip is going to take you through the financial results. We'll quickly touch on the Sandhurst Trustees Estates acquisition and give you an update on that, and then finish with strategy and outlook, and then we'll take questions at the end of the session. So an overview of the results. Firstly, we've had very healthy underlying revenue growth. The headline revenue is down a little, but given the expense management we've had, our net profit after tax is up 2.9% to 7.2 million for the half year. Our funds under management, advice, administration and supervision are up 26% to 72.5 billion, so an excellent growth in funds. And our dividend has increased from 34 cents to 35 cents per share, so up 3% on the corresponding period in FY16. I should say these results reflect a business that really has been in transition over the last 12 months. There's been significant change in revenue as a result of us exiting non-core activities, where we exited funds distribution in our corporate trustee services business, and we outsourced our superannuation administration in our superannuation business. I also just want to remind you that we've put significant investment into the business over the course of the last 12 plus months. One in the corporate restructure of the business, upgrading the superannuation offer, and upgrading our risk and compliance framework. Now, the business really is on a growth trajectory. We've had great results in our corporate trustee services performance, which I'll walk you through. We've seen improving momentum in our trustee and wealth services business across many of the lines of the products and services there. The acquisition of Sandhurst Estates business, earnings accretive in FY18, is absolutely in line with our strategy. And our operating model review, which I've spoken about before, is exceeding expectations in terms of what we're achieving and the timeliness in which we're achieving it. So we have been building a platform for growth. The three major initiatives we undertook in FY16 were to reposition the business. The corporate restructure, which put in place a new holding company, has provided us with funding flexibility, which has been important. The repricing of our superannuation offer and the outsourcing of that administration means that we've reset that superannuation business so it's a competitive position and competitive structure for the market. And we exited the distribution of third-party funds distribution on the back of one of the clients taking that in-house. The operating model review we instigated in July of 2016, so just over 6 months ago. It's now in its implementation stage. That's about simplifying the business, improving productivity, enhancing the customer outcomes. And I can say that we have already locked in an annualised cost saving to date of $2.7 million, and that is starting to come through in our results as we speak. We've got a sound capital position, which Philip will touch on. I'm really happy to say the leadership changes we've made are working well for the business. We've also strengthened the board in the course of the last 6 months with the appointment of Glenn Sedgwick in August, and the announcement on Friday of the appointment of Jim Minto, effective 1st of March. I'm delighted that Jim has joined the board. His track record is first class, and he will bring really appropriate experience to this company. I just remind you of our strategy. We are pursuing very attractive market opportunities. So in our private client business, it's about the demographics in Australia and the wealth in Australia. In our corporate lines of business, superannuation and corporate trustee services, it's primarily driven by the growth in superannuation assets. We're trying to establish very clear growth drivers for each business. For corporate trustee services, where we provide responsible entity services and other corporate opportunity, we're very clear about our positioning and what we put to the market. In trustee and wealth services, we've got services to private clients. It's convenient to think about that as our traditional trustee services, which people will be familiar with, so estate planning, estate management, trust management, advice and funds management. And then newer lines of business, our philanthropic business, where we've been number one in the testamentary space, but we're building our living donor space as well. And compensatory trusts and Indigenous trusts are new lines of business for us. In the superannuation side, our focus is on the trustee for partner model, where we take on trusteeship of other superannuation funds. So I believe we're strongly positioned to deliver on this strategy. Just the highlights in corporate trustee services. Over the last 6 months, we have been successful in winning quite a number of new clients, and I've just mentioned a number of the names up there. I'll bring out 2 points. That's an excellent mix between global managers and local domestic managers, which has always been the success this business has been built on. Each of the 3 graphs there show you the growth in the number of managers that we've brought on through the course of the period. The number of new funds has increased from just over 200 to about 240. And I mentioned before, our funds under supervision in this area has now increased from 50 billion to just over 60 billion on the previous corresponding period. So really very, very healthy growth rates in this business. If I look at Trustee Wealth Services and the growth highlights, you can see that we're seeing good momentum in our traditional business on the left-hand side there. Estate management is up, and the size of the estates we're managing has increased significantly. We've got perpetual charitable trusts, and new testamentary trusts has also increased on the previous corresponding period. And on the right-hand side, our emerging trustee services in new areas, Indigenous trusts, living donors and compensatory trusts have all increased through the course of the period. And we're still waiting on the appointment of a new Indigenous trust client, which is not shown there in those figures, but will start before the end of this current financial year. So that's all I wanted to say in terms of giving you an overview of the results. I'm going to hand over to Philip Gentry now, who will take you through the financials.
Thank you, Mick, and good morning, everyone. I'd now like to take you through a little more detail on the financials, and let's start with the profit or loss statement. Here you can see something of a summary, and as Mick mentioned, this is a transition year for us, and you can see here the headline revenues down 7.3% and reflects the exit of corporate funds distribution and the exit of the superannuation administration. However, you'll also see that operating expenses are also well down, and project and redundancy expenses are down, giving a net profit before tax that is up about 5.1% and a bottom line NPAT up 2.9%. And if you have a look at the margins, you see the operating profit before tax margin is down slightly, and that also reflects the exit of those businesses without really any corresponding reduction in FUMAS in relation to corporate funds distribution and super admin. However, the bottom line profit margin is actually up slightly. Let me just take you through the next slide, and we'll look at the revenue growth in a bit more detail. This slide strips out the impact of exiting the funds distribution, the impact of the superannuation upgrade, the ASX impact on TWS on that PCP period. You'll see a reasonably healthy underlying revenue growth of 6.8%, which and the organic growth is reasonably solidly starting to offset that exit of those 2 businesses. If we now turn to looking at this pretty strong growth in funds that we've seen, you can see the TWS, FUMAS. These are first half 15, first half 16 and first half 17. So essentially they're all post the acquisition of ANZ and show pretty healthy growth. And if we look at TWS in a bit more detail, you'll see here the impact of the super from an earnings standpoint. There's a net effect there. You'll see the underlying improvement is still reasonably evident in that business. And you can see the funds on the right-hand side also a pretty healthy increase on the PCP. Similarly with CTS, you'll see the impact of the distribution exit there, and actually fairly healthy underlying growth going on in this business, and of course pretty strong funds under supervision increase as well. If we look at the corporate trustee services track record in a little more detail, here you'll see it's been very consistent over quite a few years, and here we go back about 5 years of the prior corresponding period. The blue bar along the bottom is the PIMCO component of the funds under supervision. We've mentioned before that PIMCO essentially taking their RE activity in-house, and that will take effect from March next month. But you'll see the underlying growth, the real growth in this business has actually been outside of PIMCO, and we expect the growth momentum in CTS to effectively replace that PIMCO revenue within 6 to 12 months. Now turning to the balance sheet. It's a pretty strong balance sheet. You'll see the change over the last 6 to 12 months here. Very low gearing, debt to equity of about 5%. We've got surplus borrowing capacity, and we've put in place recently a new facility with our bank, increased its capacity to 30 million. We're currently about a 12 million borrowing, and we've got substantial headroom in our covenants. The cash that you see on the balance sheet is largely, not exclusively, but a fair bit of it is effectively capital held for various licences. In providing a bit more detail on our capital position, we're comfortably meeting all our regulatory capital requirements. You'll see we have a requirement to keep a fair bit of cash on the balance sheet. We do see opportunities to improve our capital efficiency over the next 6 months or so in the region of 4 to 5 million. In terms of what our capital needs are in the future, if CTS continues to grow at circa 10% on a sustained basis, then it's about a circa 3 million capital requirement per year that we need, which broadly speaking can be, while paying a dividend of 70-90%, can be self-funded. And the last bullet point there is in relation to the new and increased debt funding arrangements, which I've touched on before. Now moving on to the key initiatives, we've been providing a fair bit of transparency around these initiatives over the last year or so, and very pleased to report that many of these are now complete and all on time and effectively under budget. So the corporate restructure, the superannuation upgrade and the business assurance project are all complete. There has been a modest amount of M&A in relation to Sandhurst. They're not particularly expensive at this point. And of course our operating model review is being implemented as we speak. You'll see at the bottom line there in the light blue, the one-off costs in total of these non-operating items have come down each half, and we expect them to come down again for the 6 months ahead. And then just giving you a little bit more information around the operating model review. Mick mentioned that we now have annualised productivity gains locked in of 2.7 million. That's up from the 2.4 million we reported to the market in December. They have cost us around 1.3 million in a combination of restructuring costs and consulting costs, and we expect this will be fully offset by benefits gained in the second half of FY17. A further phase of the operating model review is underway, and we do expect further incremental improvements, albeit probably not quite on the same scale as the 2.7 million already realised. So in summary, most of the key one-off initiatives have been completed. We've strengthened the corporate structure and the risk management framework. We've got good organic growth momentum. We expect the organic growth and further productivity improvements over FY17 to significantly offset the earnings impact of the funds distribution exit and the super upgrade. The group operating model review is ahead of plan. We've got a strong capital position and the capacity to support our growth plans, and we're still targeting a significant improvement in NPAT for the full year FY17. Let me pass you back to Mick now to take you through Sandhurst and our strategy update.
Thanks very much, Philip. I want to just go back and touch on the Sandhurst Trustees Estates acquisition. So we announced this to the market just before Christmas last year on the 19th of December. This is the second acquisition we've made of a bank-owned trustee business, the other being of ANZ's trustee business back 2 years ago, just over 2 years ago. We are going to make a commitment to the values of customer service and care, so we're going to retain our presence in the Bendigo community. That's very important. This business has an incredible history in that community, and we'll be maintaining that presence there, and delighted to do so. And this is a great partnership that we're entering into with Bendigo and Adelaide Bank, and we expect to continue to expand that relationship over time. just remind you, the parameters of the business. It's not a huge business, but I should say it's absolutely on strategy to what we're doing. These products and services that Sandhurst Trustees offer are absolutely the core products and services that we offer in our business. So we expect it to fold into our business in a very convenient and integrated way. If I move on to the key terms of the acquisition, the purchase price of the business is $5 million. It is conditional on ASIC approval and transitioning it across. We've submitted an application to ASIC in the middle of this month, and we do expect success there by the end of March, which is according to in line with our plan. Post completing the deal, we expect a 4-month transition period in taking the business on. We do believe it's low execution risk for us. We have the internal expertise to make this integration happen. We're familiar with Sandhurst Trustees Estates legacy systems, so we've worked with those systems before, so there's nothing, we don't expect anything different in this occasion. We are taking on all of the employees of the business on a temporary secondment period to start with, so again that will limit the risk as we bring on this business. Where we've recruited one of the senior people to our business already. We've gone through and talked to all staff, and very close to having identified the staff that will be able to continue on in that business. So very comfortable with how that's going to progress. I should also say that we've entered into a 5-year mutual referral agreement with Bendigo Bank, whereby they will refer to us opportunities for estate planning and like trust services. And likewise, we will refer back to them, to their financial planning business, any advice requirements of our customers that have come through those sources. And as I mentioned before, we'll be maintaining our Bendigo presence. The acquisition will be earnings per share accretive in FY18. The purchase price can be funded out of our existing liquidity and funding arrangements, so we don't expect any material impact on our capital requirements. In FY17, we don't expect any material impact on our earnings, and then in FY18, I've shown you there the numbers at the bottom of the slide. We're expecting revenue of around $2 million per annum and increased EBITDA of $1 million per annum. Now, I just want to move on to a strategy update and outlook for the business. Just to remind you, Equity Trustees aims to be a market leader in key parts of the wealth value chain. And just to be clear, what we do is we provide wealth protection, so in both our corporate and our private client business, where we're acting as responsible entity or superannuation trustee, executor, acting under various powers, the services we provide in funds management advice and custody, that is all around protecting people's wealth, either individual private wealth or group or funds type wealth. We also specialise, of course, in wealth transition, so the services we provide in wills and estate planning, in trusts and philanthropy is all about transitioning wealth from one generation to another generation or to other parties. So I'll be very clear, that's what we specialise in. We have been building a platform for growth. We've been restructuring and repositioning the business so that we can drive organic growth through growth in funds and growth in the margin on those funds. And we do see expansion opportunities both in our core markets, so as you've just seen with the acquisition of Sandhurst Trustees Estates business, and also other bolt-on arrangements that we may be able to put in place. And I'll talk a little bit about our aspirations in the Asian markets for our corporate business. I've gone through this slide before, but I think it's really worth bringing out some of the key points. So when you look at the growth drivers of the market for our private client business, that we are in a very sweet spot for the demographic changes in Australia. So the current population in Australia has 500,000 people over the age of 85, and expect that number to double in the course of the next 20 years. So it is the fastest growing demographic in Australia. And with that demographic, there is very significant wealth transition that's going to occur. So it's projected that intergenerational wealth transfer will be about $85 billion per annum in the year 2030. And just bear in mind, this is exactly where we are targeting our services. That rise in wealth is also driving increased philanthropy, and whilst in the past in Australia that has typically been testamentary philanthropy, we're seeing increased interest in living donor philanthropy, which is fantastic. And then finally, we're seeing growth opportunities in new areas, Indigenous trusts and compensation trusts. Our two lines of corporate business really are underpinned by the growth in superannuation assets. No surprise to anyone that growth rate is projected to be very healthy on the back of the mandated contribution levels. Currently, those assets are 1.1 times GDP. Expect to reach a stationary point at about 1.6 times GDP in 20 years' time. So again, a very healthy underlying growth rate. And that growth rate is in excess of the growth of the Australian capital market, which should and has led to increased use of global asset classes. And of course, our corporate trustee services business has been perfectly positioned to capture that growth in non-domestic asset classes. I think this slide is really important for talking about our success with different partners and financial institutions. What we offer various financial institutions who refer business to us is an unconflicted model. So, we don't compete with them in areas of financial planning and funds management, as the case may be, and we can offer them a specialised service in an unconflicted manner. So really this again is going to the heart of our business, that we're a leading specialist trustee business and ideally positioned for future consolidation in that part of the market. And there's some of the names on the right hand side of our key distribution relationships outside of the legal fraternity, which is also a key referrer of business. The focus for our Trustee Wealth Services business over the course of the next 12 plus months, as I mentioned before, preferred choice by advisors, financial planners and legal fraternity for providing trustee services. That's a really important driver of our business, and particularly our estate planning business. The second key driver is really our client-centric services, so that often we will take clients on and take them through a life cycle of estate planning, estate management, trust management, and then advice to beneficiaries, and then circling back through that whole process again. So they're the key drivers of how we grow the business. Now, it is underpinned by a very significant will bank. So our current will bank is 30,000 lives with $20 billion of assets at the time of writing those wills. We're adding to that with the Sandhurst Estates acquisition. We'll add another 25,000 wills to our will bank. And we are increasingly looking to grow this business in new areas. And I should say all three of these areas, living donors, compensatory trusts and Indigenous trusts, are new areas of business to Equity Trustees, and the capability for them came across with the ANZ Trustees acquisition. And we're very excited by the opportunities those areas offer. On the superannuation side, we're looking to consolidate our leading brand as for independent superannuation trustee services. We're looking to increase our market share in the trustee for partner market. I can say that we've successfully won and signed a new fund to come on board very shortly, just subject to some conditions that need to be satisfied, but it is signed by both parties. That's $500 million of assets coming across that we will take on trusteeship for. So very happy that this part of the business is starting to show that growth. And we're well progressed on a number of other large strategic inorganic opportunities for the business. Corporate trustee services has substantial opportunities. This is a very similar slide to what I've shown before, but that shows you that the strategy has been working. We don't need to change it. We need to just continue prosecuting this strategy. There are new product designs coming into the Australian market, and we're increasingly seeing our existing clients taking the opportunity that those give them in terms of opening up their fund to new product designs and new investment choices under the attribution managed investment trust regime, which basically allows new types of investment options to be put into existing managed investment schemes. So we're seeing that activity increasing now, and we expect to see it increasing up to the end of June this year. We're leveraging our experience and our relationships with superannuation funds and funds managers to come up with special purpose vehicles and funds of one, as we call them, F1. So these are designs that allow both superannuation funds and fund managers to design funds that neatly integrate into the superannuation investment program. So we've been the beneficiary of quite a number of these new funds in the last 12 months. We're looking for new markets in terms of corporate trustee appointments. So this is outside the responsible entity sphere. So we're looking to expand that business. We're putting a new person into Sydney shortly in the next couple of months. We've established a new client portal so that we can service this part of the market much better than we have in the past. And finally, Asian expansion. We've been winning new clients, both Singapore and Korea, over the course of the last 12 months. And as I've said before, we're looking to increase our presence in the Asian region as some Australian managers look to move up there, but also as we seek to capitalise on our leading position in Australia in terms of being a fiduciary for managed investment schemes as to how we can do that in other markets. I want to just talk about 6 key drivers, and these are really the drivers that our staff focus on. So I mentioned before, we're looking to increase our funds under management, advice, administration and supervision, because that really does underpin all of our revenue. At the end of December, that number is $72.5 billion. We're looking to grow our sales value. So, you may think maybe a trustee company isn't as focused on business development and sales and very much focused on its existing client base and its obligations and responsibilities. But we do seek to be a business that grows, and it's very important that we understand the value of the sales that we make, because many of them are long-term sales that create long-term value. We're looking to enhance our operating margin. In half year to 31 December, that was 31.6%. We think we can do better than that over time. We also focused on improving our customer satisfaction. So the operating model review is all around that, as well as improving our productivity. But we want to be very clear about what our customers and also our referring partners are looking for in the services and products that we provide. And we'll be looking at surveying through Q2, and this is the first time we've done that in the business, and we will be doing it on a regular basis after that. Lifting employee engagement, which I'm pleased to say we have done over the course of the last 6 months. Despite the changes that we've been putting in place, that has increased by a material amount to 55% of the workforce being engaged, and we want to see it much higher than that. And finally, because we can deepen the community impact that our philanthropic business can provide into the Australian community. In 2016, we provided $71 million into the community to a whole range of great causes, and we're looking to grow that part of the business. Now, if we can achieve all of these things, we're very confident of what that will deliver in EPS growth and our return on equity. So in conclusion, we are operating in an attractive industry in both our private clients and our corporate lines of business. Got very good organic growth, up 6.8% over the prior corresponding period. So very happy with that. We're capitalising on the recent investments we've made in the corporate restructure and upgrading our superannuation offer to market, and our risk and assurance framework and governance has been upgraded. The operating model review, as Philip took you through, has achieved $2.7 million already in annualised savings, and we've got that ahead of schedule. Very confident about what we're doing there. We're looking to compete in markets where we can be a leader, and that's in the specialist trustee market. The Sandhurst Trustee Estates acquisition improves our scale in trusts and estates and is absolutely in line with our strategy. I can repeat we're on track for a significant improvement in NPAT for the full year FY17, and we do believe it's a very encouraging outlook for the business for FY18 and beyond. So that's all I wanted to cover, and now we're happy to take questions, and they'll get delivered online, so we'll just give people time to put any questions that they have in. Thank you. We're still here and just waiting to see any questions if they come up online. This may be a sign that the presentation was that clear that there are no no questions apparent, so we'll just give people a little bit longer to see if there is any. We haven't received any yet, but I should say to people on the call that we are now, we'll be out in the market over the course of the next 5 days, talking to various shareholders and brokers and others in the market. All right, I do have one question now, and that is, are we happy with the relationship and the level of referrals from ANZ? Look, I think that's an excellent question. We've been now, it's been just over 2.5 years in which we've had the relationship with ANZ, and I should say they've been absolutely cooperative in every way that we could ask of them. We are certainly getting a good level of referrals out of, particularly out of their private bank area. We've had access to their broader financial planning network as well. And we are working with them on some other initiatives on the philanthropy side of the business. So I think in summary, we're very happy and very comfortable with how that relationship is panning out with the bank. Okay, well, I don't think there are any other questions coming through. So as I said, we'll be out talking to shareholders and brokers over the course of the next week, and as the business has been in a transition over the course of the last 6 to 12 months, there's been a number of very significant one-off investments made, but I'm pleased to say that the operating model review that we've been undertaking over the last 6 months is paying off as we expected and really exceeding expectations. And I think we've got very clear areas of growing this business in a very attractive market. So thank you all for coming online this morning and listening to the presentation, and look forward to talking to you later in the course of the year and certainly as we get to our full year results. So thank you very much.